Welcome to the Phuble podcast, the podcast where we talk about all financial markets around the world. I am Philemon Viennes, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. Let's go over the indices for this past week. It was a good week for all U.S. indices. A lot of positive factors in the market. The Dow Jones popped up above 27,000 this week to 27,219. The Nasdaq remained above 8,000 and increased to 8,176. The S&P popped up above 3,000 to 3,007. The S&P and the Nasdaq decreased on Friday, September 14th. But the Dow rose close to its all-time highs, actually. The main story for this week was the Russell 2000, which climbed up to 1,578. The Russell 2000 measures small cap stocks. So there's a big influx into equities this week. And you can see that clearly with the 2s and 10s, the U.S. 2-year Treasury yield and the U.S. 10-year Treasury yield. The 2-year yield increased to 180 and the 10-year increased to 190. When treasury yields increase, that means money is flowing out of bonds and most likely into stocks, and it clearly was with the increases in the indices. Oil remained between that $55 and $65 range for WTI and Brent that I've been discussing for the past couple of weeks. WTI decreased to $54.85 while Brent decreased to $60.22. Once again, still believe oil is going to remain in that $55 to $65 range. The only factor I can actually see that would maybe increase oil would be Saudi Aramco's IPO filing. Saudi Aramco is the state-owned natural gas and petroleum producer for Saudi Arabia. So the Saudi Arabian government owns Saudi Aramco, and they are looking probably to file the biggest IPO ever, maybe around, I think, $1 trillion. The revenue for 2018 was close to $400 billion, I believe. They're a massive company. So it's in Saudi Arabia's best interest to actually decrease the global oil supply and thus increase oil prices before this IPO filing. That would increase the price of the IPO. That's really the only increase in price that I could see. But I don't believe that they'll be able to really drive up prices too much, especially since there's a lot of U.S. fracking going on. Basically, these frackers come in, they drill, they export the oil, and then drive prices back down. And then there's a certain range where they can't make money, so then they just stop. So I really believe that unless there's a major global restriction of oil, it's still going to remain, WTI and Brent are still going to remain between that $55 to $65 range going into the end of the year. Gold got crushed this past week, actually, and that's probably because of the increase in cash to the equity market. The spot index right now is at 1,488. That's down below 1,500. COMEX is also down below 1,500 at 1,499. Gold is going to bounce back up. This is just a temporary shift, I believe, short term. Gold is probably going to bounce up back above 1,500 next week. There was just a massive shift into the equity market this week due to a number of factors that I'm going to explain in one moment. Gold is still on that upward trend, and I believe it's going to keep going up towards 1,600 going into the new year and then continuing all throughout 2020. It was just that influx into the equity market away from like the commodity market and the bond market. Now, the main reasons that the market was up this week were because of the expectations for the Fed to cut interest rates down 0.25%, the easing of trade tensions between the U.S. and China, retail sales growth from August, the ECB cutting interest rates, and Donald Trump's aggression toward the Fed to cut interest rates as well. The Fed meeting is next week. They are going to release their decision to the public, I believe September 18th. The current Fed funds rate is between 2% and 2.25%. The target is 2.25%. The market is looking for them to cut 0.25%, so down to the range of 1.75% to 2%. And hit that 2% target range. Donald Trump wants the Fed rate to go to zero. He actually called the Fed boneheads in a tweet. He said the U.S. should refinance debt. He also indicated that he would maybe like the rate to go below zero. and be in line with Europe and a lot of the rest of the world central banks that have rates below zero, their negative interest rates. That's not a good idea. That's not a good idea at all. I don't like that. First of all, he should not be attacking the Fed. Once again, the Fed needs to go off of data. The economy looks strong right now, actually. Retail sales came out for August. Retail sales were up 4.1% for the last 12 months. And in August, retail sales rose 0.4%. A lot of analysts were predicting that retail sales would only be up about 0.1% to 0.2%. The main indicator in that slew of data that came out this past week for retail sales in August was that auto sales were up 1.8%. That means that the American consumer is healthy. They are buying large priced items. Also, that 0.4% number, although it was down from the July number of 0.8%, it still signals great consumer spending. The Fed needs to look at all the data points and decide whether it should cut or not. I think the Fed rate should stay the same. Based on the data that has been coming out, company earnings have not been slowing that much for Q2. I believe they should hold interest rates. I don't think they should cut right now. I think 2% to 2.25% is a good range for the Fed funds rate. I don't think another 25 basis point cut is necessary. Regardless of what I think, though, Donald Trump does not need to be attacking them. They're going to cut, most likely, because the market is forecasting them to cut. Jerome Powell is very, very in tune with the market. I think the pressure of Donald Trump also weighs on him as well. Last meeting, 2 board members were actually in dissent of the rate cut to 2.25%. This meeting, if they cut again, probably more board members are going to be in dissent. I think there is a slowing of the economy coming. But like I've said before, you don't want to propel that economic slowdown into something a lot larger than what it is going to be. The European Central Bank lowered their interest rate to negative 0.5%, down from negative 0.4%. They're probably going to lower again in the future. They are buying back bonds. They're buying between $20 to $25 billion worth of bonds per month for quantitative easing in Europe. Another reason, going back to why the American stock indices were up, and I think a lot of the global indices were up too this week. China exempted shrimp, cancer drugs, and pesticides, among other categories, from their tariffs. Then Donald Trump agreed to suspend the tariff increases to October 15th. The tariff increases that were supposed to occur on October 1st, he suspended to October 15th. That is the increase of the 5% tariff on $250 billion worth of goods on China products. That tariff was supposed to be an increase from 25% on $250 billion to 30%. China then in turn said that they would exempt pork and soybeans from the Chinese tariff. They haven't released details on that, but if they were to completely remove the tariffs on pork and soybeans, it would return soybeans to 3% tariff, and it would return pork to a 12% tariff from a 72% tariff that is currently enacted on frozen pork, from American frozen pork into China. I think going into the end of the year, these indices are going to increase. Donald Trump talked about an interim trade deal. I think they're going to manage to get that. When he said interim trade deal, I think he means kind of like a pause in the trade war, at least probably until the election. I think he's realizing that this is affecting the economy and he doesn't want that going into the election. So I would bet that he puts a pause on this trade war. I don't think anything's going to be really settled until after the election, like I've been saying. But I think these indices are going to keep going up, probably through the new year. I think there, once again, is an economic slowdown coming here in the U.S. The American consumer cannot keep driving the American economy forever. There's going to be a slowdown. I do believe S&P, NASDAQ, and Dow Jones will increase. I also do think the Russell 2000, the small cap index, will increase as well. There's a lot of propelling factors in the market right now. A couple news stories affecting stocks this week. Apple held its Apple event this week. It announced the Apple TV, Apple Arcade, 3 new iPhone models: the iPhone 11, the iPhone 11 Pro, and the iPhone 11 Pro Max. The iPhone 11 is priced at $700. The iPhone 11 Pro is priced at $1,000. The iPhone 11 Pro Max is priced at $1,100. There are apparently better processors, cameras, and battery life in these iPhones. They're just updated versions, really, of the 10. There's nothing really special about these, I don't think. I don't think it's really going to drive iPhone sales up. The main items that actually could really impact the stock are the Apple TV Plus subscription and the Apple Arcade subscription. I like the Apple Arcade. That's basically a video game streaming platform. So you pay a subscription per month and you can stream as many games that are on the platform as you want. The item that I did not like is the Apple TV Plus. I think the Apple Arcade will help drive revenue growth for Apple. I think the Apple TV Plus will not. Apple TV Plus is their streaming service, and that is going to be priced at $4.99 per month. It is going to be made free for anyone buying a new iPhone, iPad, Apple TV, or Mac for a year. Right now, they have 9 shows offered for their launch in November. November 1st is their launch. They have 9 shows at $4.99 per month. They're the cheapest out of the paid streaming services, such as Netflix, Disney Plus, and Hulu. I don't like this. I think they're going to lose a lot of money on this streaming service. The television movie business is very, very difficult. You spend a lot of money to produce something that may or may not work. There's no guarantee. Apple has no experience in this field. None. They have no experience. They're going to spend billions of dollars to produce content. This is how the entertainment business works, and I know because I've worked in it. You're literally standing about 50 feet away from a dartboard, and you're paying about $50 million to try to hit a bullseye. Most of the time, you're not going to hit a bullseye. Most of the time, you're going to miss terribly. And that's what's going to happen with Apple. They're going to spend a lot of money trying to hit a bullseye, and they're not going to. When you put money into Hollywood, you don't get that money back. Like, money goes into Hollywood, and it doesn't come back out. What I think they should have done is they should have developed a user-generated platform. You shift the risk away from yourself onto someone else or onto something else. They should have created Apple's version of YouTube. That's basically what I'm saying. Google is just now figuring out how to make money from YouTube. I think they could take YouTube's model, implement it into the iOS software, kind of like how Google did with Android and YouTube, how YouTube's basically implemented in the Android software. You buy an Android phone and you automatically have YouTube on your phone. I think they could do that. It's free. You have access to millions of people already. They don't have to pay anything. Not only that, but you get access to the developing world who does not have money to buy subscription-based platforms. They don't. I think they would be able to figure out that user-generated video content faster than Google would. I really do. Because Google is struggling to figure that out with YouTube. YouTube, I think, is just going to take over everything because it's free, it's user-generated, people have access to it in the developing world. Those 3 reasons alone, I think that YouTube is just going to explode exponentially. But I think Apple right now was in that position to develop something like YouTube. It would cost them probably 10% of the amount of money that Apple TV Plus is going to cost them. I really, really don't like that. And I think that they are going to lose a lot of money, especially in the beginning years, from Apple TV Plus. Just to put this in perspective, Netflix offers 5,800 shows. It's priced between $8.99 and $12.99. Disney Plus will have 7,500 TV episodes and 500 movies, and it will be priced at $6.99 per month. Apple, once again, will have 9 shows at $4.99 per month. No one knows what content is going to be a success. You can do hundreds of marketing studies and have an idea, but it's still not representative of the entire population. It's difficult. You're not going to get a Game of Thrones right off the bat. You're not going to get a Friends. You're not going to get an Office right at the beginning. It takes time, and it's trial and error. That's all it is. I mean, it's so tough. I wish they would have released the user-generated platform, followed YouTube's model, and they would have figured it out. They would have made a lot more money than Google is making from YouTube right now. They're not, and I don't know. Apple sits right below 220 right now. I think it's going to probably decrease before they released the Apple TV price and all the details surrounding the package, I really liked Apple. I don't like Apple right now. I think it's going to decrease probably around 200 in the upcoming year. I really think they're going to spend a lot of money on this content and they're just not going to be able to profit off it. They're just not, because I know what the entertainment business is like. In order to be successful in it, you have to have someone on set, on site, monitoring all costs. Hollywood doesn't care about costs. Let me tell you that right now. They don't. I think Netflix has gone through the process, so they're going to be in a good position to keep increasing in stock price. I think Disney also is going to have an issue on the technological side of things. Disney has the content, but it's just the technology to actually supply all that content to users. The best company in the streaming space right now is Netflix. Hands down, they've been through it. They've pioneered the industry, the streaming industry. They're in the best place. I think Hulu second, and then probably Disney Plus, and then Apple TV is going to be way down the list. I hope they prove me wrong because I really do like Apple. Once Apple released this at their event, Goldman Sachs issued a markdown of the stock price to 167 over the next 12 months. I have to say that was due to an accounting shift from hardware to services. So basically, they're going to take that free service that Apple is providing. So Apple is saying, okay, $5 per month, 12 months, that's going to be $60 per year per free trial. They're going to basically take that off of their income statement and they're going to expense it. I think in services, it had nothing to do with the price, had nothing to do with the trial. It's just how Apple accounts for this free trial of Apple TV Plus. I really didn't understand all the numbers associated with this decline in the stock price target over the next 12 months. It has nothing to do with the basic fundamental principles. One stock that is not in the news, but I was thinking about this earlier this week, and I wanted to talk about this. Upwork. Upwork has a market cap at about $1.65 billion. For those of you who don't know, Upwork is a freelance website. They have users in countries all over the world. They are growing. They are not a $1.65 billion company. They are a $15 billion company. They are going to exponentially increase in stock price over the next 5 years. Recession or not, they are going to increase. They are a good company. There's a model that they use. You can either buy a subscription, which I think is like $50 a month. That's their subscription above basic. I think it's like pro. You don't get charged the fee when you pay your freelancer. Or you can choose the free basic model, which is what I do. So when I pay my freelancers, whenever I have a job, they charge a processing fee, which is like about 3% of the price that the freelancer charges you. They also take, I think, about 10% of the money that the freelancer gets. So they make money in several ways. They're a lot easier to go through than like Western Union. There are people on this platform in almost every single country around the world. They are growing, they're increasing their talent pool, and it's a fantastic platform. They're a $15 stock. Like I said, $1.65 billion market cap. Their revenue for Q2 in 2019 was $74 million. Their net income was negative $2 million. They have positive cash flow in the operating category, the investing category, and the financing category. They're in such a good position financially. Their debt to assets ratio is about 10%. They have $448 million worth of assets and $191 million worth of liabilities. Their balance sheet looks clean. More and more people around the world are going to use this platform. When you look at a company, you should look at a company that can integrate into all countries around the world. And Upwork is one of those companies. They're going to be a tech powerhouse in the future, in the next decade. I think they launched in 2015. I was one of the first users on their platform. I love it. Their IPO was actually in 2018. They're going to increase so much. That's it for this week's Phuble podcast. Thank you all for watching and happy investing.